Okay, so I just moved over to my tablet here, so my voice might sound a little bit different. I just wanted to give us a basic idea of using calls and puts in a very simplistic manner, just using them on their own. We're not putting them in combination with each other or anything like that. We're just using them standalone. If you're buying a call, selling a call, buying a put, selling a put, and what situation would use those in an ideal, perfect, if we had a crystal ball, we could see the future, what would we do with these calls and puts? Now, again, let's talk about having this crystal ball. And this crystal ball is giving us a little bit of insight. It's usually right, so it's usually giving us some insight into the future. But the deal is, with our crystal ball, we can only do one thing at a time. We can buy a call, we can sell a call. We can buy a put, we can sell a put. We can't do both. Okay, we can just use one thing at a time. So let's just take a look at this chart here. Now, this is a candlestick chart. Each one of these candles, each one of these bars here. Let me just use a pen here and see if we can go in there. Each one of these bars here represents a time frame. It could be a day, it could be 4 hours, it could be 5 minutes, it could be 1 minute. I think this is a 4 hour or a daily chart. I think this is actually a Bitcoin chart, but the chart doesn't matter. It's all the same. It doesn't matter if it's oil, gold, a stock. It doesn't matter. It doesn't matter. So let's just take a look. Let's say we had our crystal ball and we had this big move. This is a massive move down. This big move down. Okay, let's just say we turned on our crystal ball right here, and when our crystal ball says, you know what? Hey, this is going to be the bottom right around here. What would we do? What would we do in an ideal situation? The crystal ball says, hey, this is going to be the bottom, and it's going to go back up from here, at least in the short term, over the next few days. Well, at this point, we'd buy a call, right? We'd buy a call. We'd pay a premium. Okay, we'd have to pay some money. Pay some money in the hopes that the price goes up, and we would sell the call right around here if the crystal ball told us to get out right around there. And we want to buy low, sell high. That's what we're doing. Okay, anytime we're buying anything, we want to buy low, sell high. I mean, this is just basic common sense, right? We want to buy low, sell high. Why do we want to do anything else? Okay, cool. Let me erase this. Okay, next. Now the price has come up to right around here, and we got out of our calls. We sold our calls. We are now flat. We don't have anything. But the crystal ball says, oh, you know what? It's going to go back down. In the next few days, it's going to go back down. We're pretty sure. What would we do to anticipate this decline right here? Well, the best thing that we could do to make the most amount of money for that would be to buy a put. Now remember, when you're buying calls, you're buying puts. You have the limited risk, right? Limited risk. You're paying something. You're paying for the right to do something. You pay some money. You hope it goes your way. It'll be worth more money. Buy low, sell high. And on the other side of that limited risk is we have unlimited profit. Well, with a put, the profit is limited to zero because it can't go lower than zero. With a call, the price could keep going up and up and up and up and up forever, right? Until expiry. So we have this very great risk reward profile. We've got tons of potential reward, very limited risk, but we had to pay some money for that thing, right? Okay, so let's say we buy our put right here. The price goes down. Crystal ball says, hey, you know what? This is going to be right around the bottom. So what do? We sell our put for more money, and happy days. We're very, very happy traders. Let me erase this. Okay, so you get the idea. Every time we have a low here, we could buy a call to ride it up. Every time we have a high, we'll get out of our call, we'll sell our call, and we could buy a put and ride it down, up, down, up, down, up, down, forever and forever and forever. But of course, we don't have a crystal ball now, do we? So, but that's the basic idea of what you want to do when you're buying calls. Now, let's just say our crystal ball says, oh, geez, you know what? We're going to keep working. But all you can do right now is sell. You can only sell calls and sell puts. Ah, geez. Okay, fine. No problem. Let's just say we're right here. Fuck's sakes. Let's just say we're right here at this point in time, right around this point in time. And the crystal ball says, hey, we think the price is going to go up. So the price is right around here. It says, you know what, we're darn sure this thing's going to go up. All right. What would we do at that moment? At this moment, when the price is just hanging right around here, well, we could sell a put. Because the crystal ball said it's not going to go down anymore. Okay, so we sell a put and we collect premium. Cool. Ideally, when we sell a put, we don't want it to go beyond the strike price. So let's say the strike price was right around this level. We want the price to stay above that level. If it goes below that level, then we're going to start losing money, right? But hey, our crystal ball works pretty darn good. So we're saying, you know what? We're going to sell a put right here. And sure enough, this thing goes up. Wonderful. Do we make more money? No, we don't. All we did was we collected some premium. So the maximum we can make whenever you're selling an option like this naked is 100%, right? All you can do is collect all the premium. Now, whether we collect all of it or half of it or 20% of it or 30%, whatever, that just depends on the situation, the style. There's so many different things. But the most we can make is 100%. Now, let's just say price goes up here. Crystal ball says, hey, you know what? We think this is a top up here. Well, what would we do? We would buy back the put, right? So we would close that position for a profit. Now we sold it for here's my pen. Oops. We sold it for really good money down there, so some good money. And up here, we're buying it back for just a little bit of money. Wonderful. Hey, we make the difference. We're super, super happy traders again. Let me erase this. Okay, so we're pretty happy with our crystal ball. It's been right all the time. Now, let's just say the crystal ball comes back on right around over here and it says, hey, this is going to be the top. The price is going to come up here and it's going to top out around here and then it's going to go down. Well, what can we do? Well, as soon as the price runs up here, which we know is going to be the top because the crystal ball is never wrong, well, we'll sell a call, right? And we'll get some good money for that, right? Because the price is going up, the premiums are expanding. Everybody's like, oh, is this thing going to keep going? So they're going to pay big money for it. And then, sure enough, the thing comes down, just like the crystal ball said. Down here it says, well, we think it's going to bottom here. We don't know if it's going to go any further. So we simply buy the call back. And we buy it back. And we close our position. And it just cost us a little bit of money to get out of that. So we made some good money selling it. We bought it back here, just like the previous example. When we're selling, all we can do, the maximum we could do is make 100%. And we would make 100% only if that call expired. Then we would keep all the money. In this case, we decided not to wait because the crystal ball wasn't sure down here. They thought, well, it seems like a bottom. Hey, we probably made 80% profit on this, so we just take it out. So let me just erase this. So I hope it's clear to see how, depending on what strategy you're using, and yes, you can use them in conjunction with each other. You could think, hey, we think the bottom is right around here after this big move down. You're going to buy some calls. Sure, fine. No problem. You could sell puts at the same time. You could sell puts at the same time. That's very aggressive. That is very, very bullish, because buying calls is bullish and selling puts is bullish to neutral. That'd probably be a lot of risk. I wouldn't recommend doing that, but someone could do that. Or sometimes they might not feel comfortable selling puts down here. They might think, geez, we think this thing might keep going down, but we'll take a chance. We'll buy some calls. Hey, we're going to pay a little bit of money, and if we lose that money, that's fine. We're taking a chance. No problem. Other times, you might be in a situation where the price is coming up and it's bouncing off here, coming up, bouncing off here, coming up, bouncing off here, and you're feeling pretty sure it's going to reject off of there, but you're not sure. Well, you know what? You could sell calls at a higher price to give yourself some wiggle room, collect some really nice premium, and wait and see. We're going to wait for that time decay here. We're super lucky, wonderful, great. It did come down, and we collect most of the premium. Sometimes you might want to sell calls or puts. Sometimes you might want to buy seller puts. It really just depends on the sentiment, the market, what's happening, your strategies. So many different factors, which we'll get into later. Now, this is obviously a very simplified example where we had our magical crystal ball, which we don't normally have, at least I don't think. If anybody has one, please let me know. I'd like to borrow it for a little while. But just to give you an idea, looking at a chart, any chart, doesn't matter the chart. You're buying low, you're selling high. Or we're selling high and we're buying low. That's all there is to it.